Joining us now is G Squared's Victoria Green, Jim Bianco of Bianco Research and Larry Adam of Raymond James. Victoria, first to you. Is the price of cutting dependence on Russian energy a recession for Europe? Can they avoid that?
I don't think so. Honestly, I don't. And I don't think we're going to avoid a recession here. It takes a little bit longer for it to hit. You know, the definition of recession is the 2 negative GDP quarters. You know, we were coming off a low place and still seeing growth coming off the pandemic. But I think if you look at all the price pressures, the inflationary pressures, and the bite that sanctions going to take, the world's getting smaller. It's going to be harder to grow. And so I don't think this is going to help any situation. I think it's good geopolitically. It's ripping a Band-Aid off. I'm not sure logistically how we're going to get this done. You know, you're constrained by ports and shipping and what we have on our logistics in the United States, but I think it's a great step forward. However, it's just going to exacerbate and pour more fuel on the fire of inflation.
Jim Bianco, Mohamed Al-Aaron came on earlier this week. He said depression in Russia. He said recession in Europe, stagflation in the United States. Do you agree with that?
Yeah, unfortunately, I do. And I also agree with Victoria. It's nice that we put together an LNG deal with Europe, but we don't have the infrastructure. It's not as much as just sign a sheet of paper and therefore they're going to get more gas. They'll get it eventually, but it's not going to stop a recession in Europe, or at least a dramatic slowdown at the very least. And in the United States, we're probably looking at drastically higher prices from here. March's CPI could wind up being something for the ages as far as how high it could be. And we're starting to see, we were seeing slowing of the economy even before the war started, and that's only going to exacerbate it.
Larry, to come to you on this, we hear a lot of people present this as a binary choice between prolonging inflation or causing a recession. And this introduces the least bad choice for a central bank. What do they pick, the one or the other? Larry, do you believe it's that binary?
I don't. I think it's a very complex situation. I think, for example, here in the U.S., I actually think we are seeing some inflationary pressure starting to ease. I know it's hard to say it, but when you look at some of the numbers that have been coming out, right, backlogs are being reduced, delivery times are coming down, freight costs are coming down. So that could be one thing that helps this economy. And then I think the Fed, keep in mind, this expansion is only 2 years in existence. And I think they're going to do everything they can to make sure that they can extend it. And I ultimately think that I'm not as concerned about whether it's 25 or 50 basis points for the first hike. I'm ultimately more concerned about where we end up with the Fed funds rate. And I think it's going to be a lot lower than what people think. I'm looking for more 2% because I don't think this economy, because it's so interest rate sensitive, can really absorb rates much higher than that.
Larry, just to put you on the spot, that's basically where the Fed is. Implied anyway by the dot plot, the median dot's there at the end of this year. Are you saying that's where it ends?
I think that's where it ends because I don't think, I mean, if you look since 1980 in each successive tightening cycle, that Fed funds rate has come lower and lower and lower. And if you think about it, last time it was at 2.5%. I think we don't get quite up to that. I think it's probably closer to 2% when it's all said and done.
Looking at live pictures of the President, Air Force One just touching down in Poland, meeting in a city not far from the border with Ukraine. Remember, of course, we've had about 3 million Ukrainian refugees since this invasion, and the bulk of them have gone into Poland, about 2 million or so. The count keeps building higher and higher. That's why the President is going here first, and from here he goes to Warsaw, and obviously we'll be talking about security too. We'll touch base with the team in just a moment. Victoria, I want to come to you. The story for me is the outlook. We've cut the growth outlook. We've had to kick higher the inflation outlook. Have we done the same for earnings?
Yeah, unfortunately, and I don't like being bearish or feeling bearish. It's a terrible thing because it ruins everyone's lives when we have a recession. I know earnings revisions haven't come down yet. I think we're all going to hold our breaths. I think I'm looking forward. I don't think we're going to see a lot of positive comments in April when everybody reports. I think first quarter might be okay. I think you're going to see more margin pressure, though. And then I think you're going to see a dour outlook. You know, inflation is going to bite almost every sector around. The rising rates is going to maybe bite technology and higher growth multiples. You know, how are you going to get your multiple expansion? How are you going to grow in this economy when you're feeling the pricing pressures from labor and from inflation? And it's not fun. You know, I think we may still see this short-term bounce, but we have been almost constant dip buyers for the last few years, and it's worked out fantastic. I've started to pump the brakes on that a little bit. You know, I think we want to be looking at quality, cash flows. You know, we're not really chasing as much risk as we used to because I'm concerned about what's coming down the pipeline. Again, these things take a little bit longer, but hindsight to that, this has been the fastest moving market we've been in ever since the coronavirus. I mean, we had a recession in what, 2 months, and this recovery was supercharged. So when I look at the signals, I don't like it, but I don't like where this market's going at all. And we're advising to be more of a seller of rallies than a buyer.
Victoria Green sticking with us with Jim Bianco and Larry Adam. As to Mike's point, they're looking at 50 basis points in May, June, July, September, 25 basis points in October, again in December, and they're looking for the Fed funds to end in a range of 2.75 to 3% at the end of 2022. Victoria Green, Jim Bianco, Larry Adams still with us. Jim Bianco, let's just start here. Your reaction to that call from Citi?
Well, it's surprising because it's a call that is outside of what the market is pricing in. I mean, Mike McKee pointed out that the market has got a better than 50% chance of a 50 basis point move in May. It also has a better than 50% chance of one in June, and it's got about a 40% chance of one in July, and it's almost priced in 10 rate hikes for this year. The story of this whole cycle has been everybody has doubted the idea that the Fed will be aggressive, and they've all been chasing the market more and more. And it's surprising to see somebody like Citi to finally come out and say, no, we're actually going to go ahead of the market and say they're going to do much more than that. Your view on the same thing, Larry, please.
Yeah, I mean, I think Jim's right. The market likes this story, right? And everybody gets behind a certain story. You know, there weren't going to be any Fed rate hikes this year. Now all of a sudden they keep, adding them on. I still think that when you look at how interest rate sensitive, I mean, look what's starting to happen with the housing market where mortgage rates have started to go. Look at corporate finance where a bunch of companies aren't looking necessarily to refinance or issue more debt because interest rates are moving higher. I think that this economy is a lot more interest rate sensitive than people think. So I think I'm going to remain in the minority and think that we're unlikely to go above that 2% or so level.
Now, Andrew says it's data dependent. So the first thing we're going to talk about is what kind of data they expect. There's a big call from Goldman in the mix as well. Victoria, I wonder what you think this would mean for the equity market. Goldman have got 2-year yields now ending the year at 290. They've got 10-year yields ending the year at 270. So basically, they're looking for some mild curve inversion for year end. Does that mean anything to you from an equity perspective?
Yeah, I mean, we're already inverted a little bit on the 5-10. The 2's not that far off. And the 30-year, I mean, if you look at how flat that back end of the curve is from 2 to 30, there's, maybe 30 basis points that separate everything? I mean, it's going. And the 5-10 is inverted. So it's not great for equity markets. Look, curve inversion is kind of your canary in the coal mine. The Fed is late. The Fed knows it's late. And now we're going to make a policy error trying to fix the problem that they should have tried fixing last year. They're going to probably be too fast in their balance sheet runoff. And it's generally going to spook the markets. I think they're going to do 50 basis points. Why wouldn't they? Inflation's going to be absolutely insane for March. I mean, like we talked about, off the charts number. It can't not be. Look at where gas prices are, food prices, used cars, new cars, all of these areas that haven't seen any relief. And so I think the equity markets are really going to need to start pricing in that, hey, this is going to be a tightening market. It doesn't mean that growth prospects are gone, but it's certainly going to be the end of easy money, and it might be a harder road to go. And so we want to be in areas that are a little less exposed and a little less growthy, because I think you could see those high multiple tech companies get hit again, because historically when those rates start moving up, that hasn't been really great for those high multiples.
Victoria, take that another step further, please. Are you looking for relative outperformance in a down market or absolute performance?
I think we can. I think value could actually still be positive, but mostly driven by energy, some by financials. So I'm not saying the entire market is going to be a horrible bear market, but I do think you could see growth similar to what we saw earlier this year. That growth could be negative. I'm not super bullish. I think we're going to be very volatile through the end of the year, but I think you could still see gains driven by value, mostly because we're bullish energy, and I don't see prices coming much below 90 through the end of the year, if not staying above 100. And there's a lot of good energy stocks that make a lot of money at those prices.
I'll come back to the energy call a little bit later. Forgive me if that sounded snarky. It's not meant to be. I'm just trying to work out what kind of market we've actually got in absolute terms at the index level. If we get the kind of calls that Goldman are talking about, the kind of calls that Citi are talking about. Andrew Hollenhorst coming up in about 10 minutes' time. Victoria Green, Jim Bianco, Larry Adam sticking with us. Jim Bianco, Larry Adam, Victoria Green still with us. Victoria, let's say that Andrew and the team at Citi are right. Let's say that you can get rates up close to 4% year-end next year and close to 3% this year, and throw in close to $2 trillion of balance sheet reduction too. What does the market look like?
I think Citi just told my market to hold my beer and watch this. I mean, I think it's going to be a wild ride. 50 basis points again and again and again. That's obviously well above consensus, and shock is never a good thing. You know, whenever you see a more hawkish than anticipated, it's typically when expectations and reality don't align up is where you see the most equity shocks. So if that happens, I would not really think it bodes well for the equity market. I would think growth gets hit harder in small caps, and I think that means the rest of the world is also going to hurry up. You know, everybody and all the central banks are watching each other. So I think this would make Europe move faster. You know, and it's probably going to put more pressure on the dollar, and we'd see it has a pretty big trickle-down effect. I don't argue with what he was saying. I think he has a valid thesis. I don't think they're going to be that aggressive. I do think they're going to balance sheet run off a little faster. But I do think that bull markets are killed by policy error, and this is lining up to be a big one, because I don't think the economy can withstand that. You know, I know we've got record low unemployment, but look at the supply chain problems. Look at what's happening with prices, and how is the Fed helping? The only way the Fed helps with inflation is to cause a recession. That's I don't mean to be glib about it, but that's the only way you stop inflation is a recession.
Jim Bianco, your thoughts on what you heard, and to the three of you, thanks for being so patient as we work through it. I think it's important to work through a call like that. And Jim, by definition, it's a forecast. A forecast by definition can't be wrong until, of course, it is. But that's the view from one bank for this year. What's yours?
Yeah, my view is very close to Andrew's view in terms of that forecast. I think what Wall Street has had the hardest time coming to grips with, I'm going to respectfully push back on Larry here, is growth is not the priority of the Fed anymore. And it is inflation. And they're going to hike and hike and hike until the inflation rate comes down. And if they're going to risk a recession, they're going to risk a recession. Chairman Powell has already said there's 1.8 point jobs for every unemployed person. The stock market's going up. I agree with Andrew. They go 50 in May. That's the new hike. They're going to keep going 50 and 50. And call me when we get to 3% in inflation, and then they'll stop. I'll remind you, I've said this on this show before, 40% of the American public has less than $1,000 of savings, and they rent. They're getting killed by inflation. It's showing up in the political polls. The Fed hears this. They hear this loud and clear, and they're going to side with trying to do something for the 40%. They see all those extra jobs. They see the stock market going up, and they say, we can go and go hard because we have to, at least, if nothing else, show the appearance that we're trying to do something about inflation.
Right now, the bond market's on board. I mean, let's sit on that just for a moment. We've got an 11 basis point move on twos. Twos have gone from 140-something at the end of last month to 225. Right now, we're looking at an 80 basis point move for this month alone. I think it was Jim Reed of Deutsche Bank earlier this week who put in his morning note that this could be one of the biggest monthly moves on a two-year yield, going all the way back to 2004. And Larry, to Jim's point, and to Andrew's point for that matter as well, and Victoria, who agrees with him to some degree, this is happening. And equities, pull up the equity screen. Equities aren't collapsing, are they? On the S&P 500, financial conditions haven't tightened aggressively through this month so far. So, Larry, why can't the Fed engineer the kind of tightening cycle the Citi are talking about?
So, look, I think the economy is very healthy right now. I think the one thing that Jim mentioned, and I agree with, is that the average consumer right now is losing ground, right? It sounds good that everybody's making, on average, $200 more per month, but that quickly gets eaten away by the increase in gas prices. That's costing people on average a little bit more than $60. The increase in food prices, up about $90. And then you throw in rents, you're underwater. And the big key will be, can we continue to raise or have job creation to offset what people are going to take away from their savings? I don't think the Fed's going to want to do anything to reduce the confidence and the hiring practices of companies. And they're going to try and keep this economy going, because, again, we're only 2 years into this expansion. And if we get into a recession, we're going to have a whole nother slew of problems that we're going to deal with as all of a sudden, tax collections start to ease. So I think they're going to do everything they can.
Larry Adam, Jim Bianco, Victoria Green, to the three of you. Fantastic conversation.